Okay. Before we start, let me get a little information for you. What do you do? How do you come to invested in market microstructure? So a little bit about.
I come from Quantinsti. I have a chartered accountancy. I have been trading for the last 3 years.
You are in the trading environment.
I'm in financial securities for liquidity research. Credit research will have the last 2 years.
Okay.
So I started sharing the algo solutions, CEPs,
Assumption writers make some algos, create some algos?
No, we have a CEP stream tied up with a company called Stream-based, and we sell CEP with Liquidity and so all those the solutions based on the government reforms like high frequency, other frequency forms.
Assumption rate is the way I know about the company is it's a H company. Like that's what you have a lot of databases. It looks like there's some interesting area.
Yeah, it's Tanvi, and I'm working with the company. I'm working on the side where I created demos and created strategies on the Stream-based platform. I completed my MBA and I also did my engineering.
Oh, the whole time.
I take it and I'm running my own advisory. We actually advise on commodities and we advise on technical
So, do you know like what kind of modeling tools that you can use or like to use?
We actually advise corporate only for hedging. Yes, we have not entered into such a product. My name is Ashwin. I was earlier associated with Morgan Stanley. So right now I'm looking at moving to trading.
What do you know about trading? Wait, moving to
mainly because I believe that this will be in trading in the perspective. 2008, so there's going to be much more opportunity on the algorithm.
So, given that, I think I don't know what you know about me, so I have a dissertation on market structure, which is not necessarily burdened with the idea of the algorithmic trade. People sometimes misunderstand that market structure means high frequency trading. That's absolutely not true. Many market microstructure models because in that case, if it is high frequency trading which is the market microstructure, then basically we have waited for market microstructure to come. High frequency trading is in more difficult. That's true. Market microstructure has a longer history than high frequency trading. But high frequency trading or those things have given us more eyes to play around because they cover them, and we'll talk about which are the relevant points. CQ is something which is my startup. In this, what we do is we take solutions and tools for it's not necessarily structure basis. Most likely to be asset allocation tools because that's where large usage of it is. Like market structure algorithmic tools are still a very small set of the total solutions market, but allocation tools almost everybody needs it because when you start, when you have some money to invest, you don't even know where to invest and how to invest, and that's the reason. So that's what we create some solutions and try to see if there are some benefits to it. You can stop me anywhere you want to if you have any questions, and then we can Okay. So okay. So the presentation today is going to be across these two components. Microstructure, the basic foundation, and there are in each of these slides you will find that some of the questions which are relevant to that top market microstructure. And I would want it to be a little interactive in the sense that, these are questions pretty much game questions. So I want you to participate and tell me, what are your thoughts regarding these questions. The second part is a little bit more of the lecture format, because there I will give you activities from one of the heroes of microstructure theory, which basically was one of the guys who first was how pricing, why microstructure is important, because it actually matters in asset price determination. That means return might actually be affected with liquidity conservation. So in traditional asset pricing, that was not the case, because you thought of just buy asset because there are only one source of risk, which is volatility. But this one says no, it is not so. Even with volatility consideration, you may have other effects. The effects coming from liquidity with one of the components of market microstructure. So it was left which paper was. So basically, he's slides on this one, so we will go that one, and that should clarify your understanding of how the market microstructure affects. In the market microstructure effects, you'll see that when you are comparing the effect of liquidity on asset pricing, there are ways you can think of it. One is that if we form a portfolio of an asset, there might be some cross-sectional effect. That means a high liquidity stock may of a low liquidity stock, and then basically on the total portfolio, the effect might be negative. So we can create a portfolio through a cross-sectional analysis. That means taking different stocks, not necessarily one stock longer for to compete performance, liquidity performance over time. So what is exactly that? The time series consideration. There you take one particular stock or one particular portfolio, and you see that how did the liquidity change, or the premium, which is the price you pay for liquidity, how is that changing over a period of time? So often these are done things like this question become very important. We are thinking of solving listing from one exchange to another, or doing multiple listing. Multiple listing has a cost, right? If you're already listed in one of the exchanges over here, so BSE, and if you want to basically go to NSE, there is some cost to it. So does that cost, or is it some sort of an incentive there is that this cost is less than additional premium we could get because getting more liquidity from NSE. So types of questions become very relevant in the time series sense that over these 2 periods of time before and after these things change. So that is pretty the presentation today. So market microstructure, and that is what is the central question of market microstructure. To answer this question, think back about if you can think of it. What is the central question of theory? Any idea?
Max versus return. Given a risk profile, what's the max
maximum return you can get, or given a return, what is the minimum risk that you can get? Or original return.
Risk-free return.
So it's risk and return. It's a matching. Find a frontier, find a combination of risk and return that matches your profile, right? So, if that's wrong, risk and return, who will in that? Invest. That is the shift where market microstructure. I have this very hard time explaining this to the students when I teach a course at IMC sometimes. That everybody is still focused about that, you know. I mean, trying to think of the market microstructure problem is that how much return I get. I said for a trader, it simply doesn't matter. He doesn't care about how much the investor gets the rate of return. He simply doesn't care. The problem is not to get. Yes, then invest in this security because this security is going to basically give you the highest rate of return. Because that the investor has come and give the trader the trade days decision about what to choose. So make the return profile which makes somebody choose to choose a particular security or a portfolio. It's at that point. So the market microstructure, the central problem is actually just a very, very simple, what is it? It's not a problem. It is the same as you want a new neighborhood, like, you know, you finish college and you get a job at a place and you want to find out the best house which you can buy a shirt. Girl can find who is going to date you or who you can date. So it's a search problem. There is nothing other than that. See, so you can think of it that we're not sure if this is your right choice. Because are risk averse, right? And one of the points about risk aversion is that you want to understand what you have. That means you don't want to eat the loss. See, most of people, their behavioral structure is that we get how much of profit that we can make because we know that profit is not natural. We have to have strategies to earn profit. So most of us, we are interested in reduction of loss rather than, right? See, that is the reason we appoint a broker, you know, because do you think, like, you know, it really matters, like, for finding out the best house that really made a profit? That means what is the chance that you will get a house if you are trying to rent one, that you will get a house which is paid less than the anticipated, you know, the current market of the right? What chance you will ever get a house? You will below the rent. Very low. On the other hand, yes, you will actually be sucked into a situation of paying too much for is very high. You want to reduce that because we want to reduce loss with having an agreement to house for 1 year, and if you realize that, you know, that was a you're stuck in a situation. Yes.
From that perspective, if you think the same probability is
exactly. Because from the landlord's perspective, what is he thinking? They could rent it to what is the probability? So instead of thinking that I will rent it to somebody who at night will get drunk on the day of the paying the rent, and because of being drunk he will pay me twice the money. What is the chance of that versus this guy with a default would not be able to pay his rent and incur a loss. First problem is in like that he is trying to basically make sure that whoever comes in that is not incur a loss by choosing the wrong person who would rather than making a profit, anticipating a profit that this guy will be assigned, for some reason will pay me twice the rent.
So you read like in an order book. Somebody is buying something, somebody is selling something, and both of them do not want to over or under cover.
Yes, that's right. For it is a loss reduction strategy rather than, and so that is basically what we have to understand, that it's essentially a search problem that basically says we are searching for the solution to our problem, and that this solution is in terms of reduction, return. The only kind of between asset pricing and this module is this. Even in asset pricing, see, Markowitz study is based on not getting the highest return. You find out a portfolio that minimizes the risk. Because of return, well, because there is a number, estimation cannot, number cannot go below 0. You know that you have a finite limit. The reason that is realization object, because if you have if you're trying to basically do an optimization, and if you, I don't know if you guys are liking it, some of these theoretical discussions, I know a lot of people don't, I don't know what's your feelings about it, but the point is that, loss reduction is a more intuitive way that gives you a tool with a finite threshold 0. Right? But you think of your it goes to infinity, and you never optimize. You can never find a function that will you that okay, do this investment, choose assets because their return is in it. That doesn't exist.
If models are not going asymptotically, and if it were a maximization function, that everybody would be there.
See, exactly, and that's the reason you also mathematically for that reason you expect return is a linear function. Linear function, where is the end of that? And then you should not optimize that function because it depends on how much water when it comes to, if it is a search problem, then basically it is something that everybody is interested in, that whoever is staying in this system, in those corporation intermediaries, everybody is interested in that search problem. Where they trade in primary and secondary markets. What do they trade? It's financial instruments. How and when do they trade? This is where basically the kind of difference that comes from portfolio or even the transition from portfolio to market microstructure. See, market microstructure risk and return thing that you said, if you say, because that is really the beginning point. What assumptions? Can you think of what are the assumptions of Markowitz theory? So minimize portfolio gains, substitute some kind of a return. What do you have in that one as a as assumption? What cannot happen? Some things are no short sell, no transaction costs, perfect borrowing. So everybody wants to borrow. So these are called frictions of market, because in the real world all functions exist, which are frictions to the market. If the frictions to the market, the market microstructure. So let's introduce these frictions one at a time in model and set how these frictions change the pricing of security from the Markowitz world to a little bit more real world. So all market microstructure theories for the reason, including the papers I have written, we try to basically take one define one. So some theories are something like is one of the guru market microstructure. The theory was that that's okay. Okay. So the market point was that some one friction. It means if you see that you create a portfolio of securities, but you cannot say that I'm going to have this quantity and this one of that quantity. The way it comes from the solution to the problem, but you have any way of choosing. Said okay, that is definitely not the case, and it doesn't happen like that. So they didn't put in trade size. The big thing is that it's structure of the market, and why it is so important that you understand that New York Stock Exchange and NASDAQ, or over here NSE versus BAC, it would be quite naive to think of it that these two different things structure. One is a electronic limit book, and the other one there is a flow. How they have possibly changed, they put some all limit side. So that you would expect that there is no difference in pricing of that is a naive thought, and that cannot again happen. Because why? Because in market microstructure thing, if you think of portfolio theory, no market maker go and buy any stock that you want.
What you want.
Exactly. But see, it doesn't happen because if you have to go through a broker systems, there is a cost of basically putting a limit. So those are not there in the theory. So there comes one thing. Then good and when they trade makes a difference. If you think of a different market, a physical commodities market versus security market, what are some of the differences?
Assets will go to zero.
Prices
Assets don't go to zero.
Prices don't go to zero.
Yeah, talking in terms of options. So options expire. The other difference could be that
option is not. Option is a
contract
on an asset.
Option would be that in spot-based delivery, wherein securities there is no delivery. So you deliver.
Is an artificial distinction, right? Because security is also by definition. So if I'm supposing a buy hold strategy, because people pay
for you,
yeah,
absolutely. You have to hold it.
We want to be
in a private market, the information is known to the market that you want to trade something, but in a limit order book, nobody knows because the information is same. So there is no information asymmetry.
Yeah. So see, if you think of it, sometimes you will be tempted to think that it is market are different than a film market. Commodities market because of the allocation issue. That is, trade. After all, it's a piece of it's a promise. Right? Securities by nature, it's just a contract that I will pay you this. If this thing happens. Since it's some kind of promise, then basically. In an explicit or an implicit form, if you can basically convey that message. So you have to have physical location. But buying this bottle, you have to have a physical location where from you get that. But that is not really true. Is that what is not true? Then because they are now with physical locations in the same space of securities market, have positions as public stock exchange and non-physical location virtual thing as the electronic trading market. We can see is that the fact that the location we get actual delivery of your certificate. In other case, you cannot be different because then both of these two things not have coexisted. The difference is clearly not that. So what is the difference? The difference is market is always a fluid concept because basically it tells you how make up versus another market. That means the key rules and protocols, those are the differences between two markets. I'll give you an example. In Jordan, the block trading, so anything above certain trading, can happen only after lunch. Is that right? Okay. So you see, India has that, Jordan has that, but New York Stock Exchange doesn't have that. So why then Jordan market or Indian market is different than that? So put a block today. You don't trade anything else. Trade is smart lot. In your options are for you. Market is not New York Stock Exchange or Jordan or this one. You are basically looking at that times of the day when you can trade in Jordan, India, and in New York Stock Exchange. So see, it is the rules and protocols that make up every individual. So first create a market of that is where the difference between stock market and commodities market. Because in commodities market you cannot do that because that's a defined space where you can with that. Right? For securities market, the whole idea of whether there is a physical location or not, that is not the point. Securities market by definition is a set of trading rules that make up the market. These trading rules vary from one market to another market. See, now that should basically give you a time to think about it. Oh, well, so securities market are basically a bunch of rules. And when you talk of soft being a bunch of codes, so there is a difference between the two softwares because some lines of the codes are different in one versus another. Then again, securities market, our securities markets are different because of those rules. That case, then, if these securities market rules favor one party against another in one of the other situations of the other, that's the case for making strategies. You would say that one trader will be benefited from what particular rule somewhere and what it would not. Because any transaction, stock market transaction, securities market transaction, is a sum game. I feel very funny when somebody said that, and I don't think it is my fault, somebody, a finance producer somewhere said that, and I copied it from that day. All say that, I make so much money from the stock market. And all the 5 guys sitting together, I think we made so much of money from the stock market. So, and this during stock market, late 90s, early 2000s, everybody would go into the computer and then do their e-trade account, and you will see a price, and you will say, oh, this is the price I should buy now and price. Now, if he buys it at that price, or somebody is selling it at that price, which means both of them cannot make profit, cannot make the things because at that price seems for the buyer. I mean, it must look very high for that, and you both of them cannot be right. It cannot be both very low and very high at the same time. stock market transaction, when people say that we all make money, that they do not know the reality. That he's definitely
somebody is losing.
Somebody is losing. Somebody is losing.
Yeah. I read this and heard this very so many times, but I never understood this. Some markets, say, I will use a hypothetical example. Say, company has 1 crore of Australia, and it is 100 rupees. So market cap is 100 crores. So buy the shares, nobody sells the shares, and then the market price to go up with fundamentals.
Fundamentals should change.
No, earnings improve for that company in a particular quarter. The growth. Two shares, market caps rises to 150 crores. Who is the right investor? Why? I don't think.
I think your fundamental flaw is over there, making the assumption that no trading for outstanding sales. So in the secondary market, is no trading, no price change. It's not change at all. Change happens in the actual trade, which means what you are saying is that okay, I want to, you can pay as high as you want, or put in an ad as high as you want.
Understood. So actually, trading of say 5% of the share. That is. Then at 2.5% people are losers. But at the time, 97.5% people are gaining.
That is, I think, even you are flawed by this argument. That is what basically gave this huge sense to people. The market price go well. You saw in your TV screen or your computer screen or in the evening news, the company's stock price went up. You had actually said your stock price went up. You immediately thought, oh, I have gained so much of money. No, because you did not sell. With next day, if you are going to actually sell, thinking that, okay, yesterday's price is going to continue tomorrow, then I can make that profit. Tomorrow it might drop below what I had it to earlier. This is the difference between realized gain and audio kind of notional price thing that you think is happening to your portfolio. So many of the portfolios, because you do not actually realize the gain or a loss unless you do transactions. So 2.5, only 5% people who did the trading, they got the other 97.5%. They got that their price went up. It was just in their fiction.
There is a change time. Say that like the stock market is like something. I understand that it can be true for options of future. When the company itself is like in terms of they are at liquidity or they are at the someone is buying at the primary market. Companies come with the issue. They sold the share at the primary market something like 100 rupees. Okay.
Yeah, hold on. Slow down. If it is a primary market that they are selling, that means that is that their stocks are traded.
No. I'm going further ahead. Now, the company is selling it now. Company is listed. Now, because the company has improved performance, okay, the price is going ahead at 120 rupees. Okay.
If it is in a primary market, they will not know.
Primary market, they have listed now. The company is listed market now. Okay. Now, because the company does a good performance, the price getting traded.
But again, you have to slow down on that one. A company having good performance, what?
Income.
Let's say that their stock price will increase. There are many companies who do wonderfully in their earnings, and still they are not perform so well in the stock market. And on the other hand, many companies which have run for losses for many years, and they have very high stock prices. Stock price is the relation between companies Second, performance and stock price performance. Zero.
Basically, the point that you are trying to make is that a company had an IPO and they listed 100. I think the price went up to, let's say, 200. Okay. So everybody gained because of the price. Yeah. But the thing is that either the company undersold themselves. No, they could have listed at 190 and then the price was
after 10 years. Something like after 1 year they are reaching to that. Something like, see, somebody has paid the price of 100 rupees. Okay, we need to sell it at 120 rupees. So they need the profit. Then with bought the share at 120 rupees, they will sell it at 140 rupees. So nobody is making the profit over here.
You're modeling up too many facts. First of all, if I take this viewpoint that okay, accounting performance is the driver for stock price, which is not, but let's assume that it is so. Because of the company's performance is truly reflected in the stock price, they have this company had an earnings of from the original $100, then during the year earnings per share was $2 per share. So then these earnings to shareholders, which means they would have given 100 dividend paid out. In that case, they would have got the stock price would have reflected $12 per share, which you are thinking. So in that case, every wins. The same, but only they win is because that is their money. They have put it in that in that company. Okay, but the stock price in the actual market, it did not come to that $12. It might come to be $8. So instead of having that dividend effect on the price, they might actually go the opposite way. Companies might think that this company we expected 4% $4 per share earnings. Instead of that, they have done $2 per share. So we are going to stop it.
Sir, due to any trade announcement, the stocks opened down by 5%.
Because some announcement, the price goes up.
Open in the morning, yeah, down.
Okay, so what you're saying is announcement is coming in after market. Like say when the market is opening, there is a gap.
Market is immediately 5% down.
When you say market is 5% down, what does that mean? That somebody has bought it, somebody is buying it at that, and somebody is selling it. So, you have to understand that you cannot talk about market price unless there is a transaction. That means somebody has bought and sold. And he has bought or sold. Those things have to happen at the same time. That means somebody has lost and somebody has won.
Who gains and who is losing?
That depends on what is that perspective. If he thinks that the guy who basically, so after morning, after the right? It opened at
if we see that the collective wealth of all the investors,
you can see that. How can you see the collective? That is a basic flaw I see in your argument is that there is no collective thing. Trading profit happens who is engaged in that transaction. So there is no collective gain or loss. The collective gain or loss is in our segment of imagination. We think that even though we did not do a transaction, just because the prices went up that morning because of somebody else buying it at a higher price, we think that we are a part of that. But it's just in accounting thing you are looking at that would be true, because unless you actually do a transaction, you're never going to get a profit. See, this basically the best way to look at this one, equity market, housing prices. And owner and in the last 5 years before this housing crash, look at their house prices. Everything they were saying, their next door house was selling at this price. So instead of thinking of their house supposed to be one very unique house. They were calculating that prices of the housing prices increasing in neighborhood.
Yeah.
So this is, but how can that be a profit if you don't sell your house? But sell your house, then it becomes your profit. But you have on the basis of that, if I would have sold my house, then I would have made that. Those that would have and could have.
So gains don't matter.
That's right. That's the point. Notional gains is
When you say volume, all in the notional gains. You cannot sold any security for last 20 years.
that's not
I'm talking about some issue.
Oh, yeah, no. If you talk of buy-hold strategy, that's what you are saying, technically. Buy-hold strategy for people who basically buy and keep it for a long time. They have finite horizon. And investors, like Warren Buffett, they are very, very careful not making these anticipatory gains, because see, that's one reason why Berkshire Hathaway, which is Warren Buffett's company, because this deep buy-hold strategy, people declares dividend. Never declared dividend of even a cent. That dividend in his framework, my framework is dividend I will pay only from realized profit, and because market value is going up or my portfolio value is going up, that doesn't say that I have actually realized profit.
Very, very true about getting dividends from the firms here.
Exactly.
You have to back to the board and get them to pay the dividend. So that is the cash profit is always there. So in their own theory, they're all right.
That's right, and that's why they all think that if this is what microstructure is, and why care about it? We know that these are. Why would you care about it? I think we have kind of talked about already a little bit of that. The first one, if you had problems, there was frictionless money, but in the real world, friction and productivation is price formation and not evolution, because portfolio remainder is a static one-period price model. So on the basis of asset allocation, you decide that I want to buy it at this point and sell something at this point. It does not tell me that where the strategy is going to continue. So next period you have to again run another, find out where you are going to hold on to this, or you are going to change your position. So it is not evolution. It does not tell you how prices change. It just tells you how prices are formed. You see the difference. Valuations, and see, that was the reason why portfolio could not be used to find out price movement, and prices are deviating from a benchmark price. You can call that benchmark price is efficient price, but how much it is deviating over time, because again, see, evolution was not a part of portfolio. You know that at this point is the price, an efficient price. But I cannot tell you that how this efficient price, how did you come to this efficient price? There is no process, price process. Price one step.
So your time T equal to what?
That's right. At any time, you can take the T at any time, but there is no going from T minus 1 to T and T to T plus 1. There was no framework for that. And now you can see that why it did not have that, because it did not consider those frictions. That means someone would basically at time T, buying a stock at time T plus 1, exactly selling that same stock. That will happen, but again, in portfolio theory, you did not have way of thinking out that why somebody buy stock at time T and at T plus 1, they would sell it, because it did not give the process for going T to T plus 1. Or things like play shares. that I want to buy a huge chunk of stock. I want to buy 1 million shares. I want to sell 1 million shares. A very different strategy than buying 1 million shares, because buying 1 million shares, they give me some additional to get a better price because I'm providing so much of liquidity. When selling, I don't want to do that because that gives a signal to the market there is something wrong with the stock. See, part of these were the frictions which were there in the market structure could capture that. So that is one of the things you can see competition for order flow. That in algorithmic trading particularly, there is this huge concept of hidden liquidity. So the whole idea of algorithmic trading is to capture not gain, price stock. Everybody can find that. All these people who said we can find efficiently priced stock, that means next period it is going to either down or go up. Either lying or is on drugs. So that they all just play this down game, and it just happens to somebody for whatever reason once in a while, and they say they become the spy. Everybody tries to follow their principle, and when they are asked, then you repeat the experiment that you did, no, I cannot do that. So it only happens. What can do though is again there is potentially more buyers when I'm a seller or sellers when I'm a buyer, because we have seen that in the morning buyers and sellers. Actually, in the afternoon, there are more buyers and sellers. Now, why do people buy and sell more at this hypothesis, but nobody exactly knows for sure? So that is why we just from kind of people coming to the market, and if we think that these people are coming what they think is the right reason, we will change because it is a Monday or it is the first day of March or the last day of April. If that is not, these are some of the assumptions we can make. We can kind of in a way make our hypothesis on the basis of this hidden liquidity. I know that if you want to go out and do some trading, then it is a good time because there is some liquidity. I'm working with a firm over here. Your company. The measures that we found research with their data, they give me the data, and every time I to some and then tell them that find out this and this and this. We found some very nice things. Now we are trying to backtest and see that if instead of one stock, it goes into multiple stocks. So one can create a trading strategy on the basis of that. We find that you take there is a measure called measure at certain times of the day, and it might also have a weak effect. That more aggressive than sellers, or sellers are more aggressive than buyers. And the way we are measuring it is through quotes. A buyer who really desperately need to buy, you within, right? We take any interval of time, very short, like 1 minute. Within 1 minute, how many times code revisions are happening? See, this is the way that how desperate it is sellers are. So if we find that at any time of the day that the buyers are really safe, it's the best time to sell because they want increasing the price every half a second. And with algorithmic trading, that's what they will do. They will, they will put a filter over there. They will put a over there that every 1/20th of a second, just go and put it in price, it by 1 cent, and go on putting in the price. See, that's what basically is in liquidity. So So order flow, that is one of the things that the reason for order flow, which into that.
The only thing, so order flow keeps price action.
Because see, we were giving a bid. Exactly, and without an order size, without saying that I want to buy this, you just give me, I want to buy some blank quantity for a price. What then you will do? It will throw up that thing, because in our system they are screening the information. If the information is incomplete, that's a false order, right? So order, if it is not there, what if you don't fill? Then it is not in a sense. See, you not give an order, so you cannot have both of the pie. That means this is very, very one. Let's say quantity, and based on that quantity, somebody gives a price. If both the price and quantity your choice, then what is the other guy going to do? Right? So you cannot have both. You can only one. So you like whether you want to choose the quantity or the price. If you choose price, okay, look for my quantity, and based on that quantity, you give me a price. If you choose quantity, then you choose quantity, then I'll choose the price. Reason, no matter which the is that, but you have to give only one at a time. You cannot do both. So this is the competition for order flow, and the rules and these are in the market regulation. That is why market structure is very closely related to this field of economics, field of industrial organization, which basically deals with how can regulation and the field to make a competitive market. So see, regulation needed in any case. Regulation is needed because economic regulation. So things like restrictions against monopolies. Because basic framework thinking is that if it is perfect competition, this is the optimal for everybody. It is competing for the store is competing for your, more likely that you will get the best price from a store. If not, other than when there is only one store in the whole area, and you go and buy it from there. So that's why they will generally have a tendency to exploit random people because you have nowhere to go. So companies are a big example of that. For banks, the regulation is because there are always people who try to and in economic sense, it means something is over above your normal that you could get. It's because that's measured. And so the only way to do the level playing field is that to create regulations. So reason you will see utility prices. If there is an electrical which provides power, it's very difficult to create competition in that market because the electrical utilities and therefore lines, the infrastructure is, you cannot give everybody to, the thing everywhere and putting types of lines over there. So because it is by nature, these are called natural monopolies. If they are natural monopolies, the only way to basically control the behavior is that you have most governments will have some regulations about how much you can charge of rates. So So rate fixing is one of the things. So you see public utilities board. I do not know if that's the thing over here, but anyway, so public utilities board. So the whole purpose of regulation is always to create a playing field and make the market as competitive as possible. Security is demand and supply of information. That is also another thing which basically comes into the play. If you are trying to do it on the basis of a securities are essentially just promises. If we promise, the promiser and the promisee, how valuable those are, see that as the big part of the company's relation disclosure. I don't know why you said he's a CPA thing. So all of you basically are employed just because of that reason, that they see for no other discipline so protected by or by statute as you guys are, because every company might fire all its everybody else, but still has to have a CPA, because this thing is very, very important, because if there is not a disclosure, because a shareholder cannot walk in there and say that I need that information, because the company is going to throw him out. It is through a regulatory mechanism that we can absolutely ensure that there is some security, demand, and supply of information. Trying to design this thing, I think one of you guys told me that Harry's book is something which you have been part of, or this book on market microstructure, it is for more practitioners. There are theories, but it's a little bit in a good way so that somebody will understand that. So Lawrence Harris, Market Microstructure, if you get hold of that book, that's absolutely the yes. So both academic as well as since he was the Securities Exchange Commission's top man on economic relations, so he is very, very well-rounded guy. And these tables, whenever I say tables and figures, these are in reference to that book. I have not given you much of this one because these are big tables, but in one, give you the details of who, when you say a individual trader, then you say what are the reasons for his trade. So you would say, you would find that you would say that an individual trader would often trade for liquidity. That's just I'm going to college, so to get in for from his pension fund. Wants to retire, so he has got some money now. He's going to trade it. So he has all those reasons. Then an informed trader would trade for what reason? A guardian would trade under what reason? So it's a whole series of all kinds of participants in the securities market and also more. Yeah. That is who trade and who trade. So if you look at that, it will give you a good sense of. It goes into what kind of products you have, financial products, and all its instruments and products. It has a whole table of what are the things that you want to trade, and that gives you a whole list of every product that you have. The national regulation support and facilitate trade. Tables 3.2, 3.5, and 3.11. It says that how. Let me give you a concrete example before I make a statement. So, on the role of clearing corporation, stock market, or any securities exchange, why isn't the clearing done by the exchange itself. This thing is very important because in terms of liquidity offerings, exchange is just a group of groups. So the brokers, they themselves are selling or buying for you, as well as be responsible for doing the clearing. Now, what do you have if it was done by the same group of brokers from whom you are buying or selling the shares?
Earlier, that was the structure. Now the structure has
actually in India, you can find that the stock exchange experts on clearing.
Yeah.
So there is so now a new regulation is coming that the clearing house is no more the part of the exchange.
Cannot be.
In India, it's not. There are two different companies, but they are in pseudo companies.
Okay.
That's the big.
But you can see that there is a huge lot of trust out there because and we was admit on that one. See, I'm a broker. Okay, I only need money. So you're money to say that I'm going to buy this stuff for you. I need it for getting on. So what happened? And then later on, 5 years later, well, it's just a clearing, like it's a long time to clear the stuff. I told you I'm going to buy, but it's just clearing to so much. Then clearing has to be by a separate organization because it cannot be the same. So the better again, you see that regulation becomes a part of that thing. So more better organized thing. There was this thing about T+2, T+3, which is from you are trading within 2 or 3 days, the clearing has to be done. And there are studies which actually found out, including what I work that I've done, I found that these trading, the settlement execution time made a difference between CAs which are considered to be efficient not by working economically. So they better give better thing to people than CAs which have a longer time in terms of so which give flexible. So ones which are follow the rules and follow the rules strictly are better operations. Okay, so let's take now a little quick and see what you guys can make out of this. There are a whole lot of questions, and these are all questions again from Harris's book. So really, I say if you want to understand this field, get that book. That's not a very expensive book because it is software. Not that book over here for India, so it's very inexpensive. And a whole lot of questions. So I've picked up a few from there. That's one topic. And just to give you which one you are choosing, so that others also can think about that, and then let's discuss this. Topics from home. So, your thoughts.
Actually, brokers profit from exchange and exchanges profit from brokers.
I think it also meant not so much just brokers, but exchanges, also from traders, like participants. So, say who profits from trading and from we need two class of traders. You can think anything in the distribution, informed liquidity, around a broker trader, the trader exchange. So you can think of any two. But specify who do you think, and then tell me what's your thoughts on
Distribution will learn more by holding capacity and learn from the small retailers. So it talks from the small retailers.
So individuals with stocks at a lower price from individual than when two institutions are going to trade with each other.
The individual gets to liquidity from institutions. Institutions basically have a better idea of where the pricing is, so they benefit from individuals in terms of pricing.
That is what you say. Do all of you agree with that, or what is your position on that? You have to think of it. Evidence, anything that, in fact, I say that in my class, and then students end of one semester with me, they all almost like a fact, they repeat that thing after me, that don't say anything for the day's class unless you have a for that one to back it up. So what do you think of what is to be state whether you like it, and what is the evidence you have for that?
Absolutely free, right? I don't think that there is too much of difference issues or institutional trading. Instead buying a higher lots, probably retail might not, right? But I think a major difference.
So I disagree with that point. That really speaking, it is not the profit transfer, the kind of resource transfer from redistribution from one to another. What you say?
Because when the individual traders want to sell their stocks, and since it shows you check that what should be buy for long term, the probability, and that's where the individual traders get.
Yeah. So you go with this two. What about you?
Say, for example, I'm an individual, and he's somebody who's an institution who's also setting the world, but we're looking at the same information in data. Right? I don't see any difference in both of us.
No. Here you are assuming that you have the same data, but that's not that. Individual have better data.
Okay, if in case there is some informed news and something which is not known publicly, then it's a different issue. But if it is accumulated down, and both of us are looking at, say, an order.
Yeah, why would you assume that individuals and institutions would have?
See, if you were trading through let's say a website, you are looking at NSE order book, you are not looking at BSE order book. If you like BSE order book, then you are not looking at NSE order book. So and that institution guy is able to access both at the same time. So there is that kind of a difference.
Even for retail, people started giving it, right? So, I think that now after this era of Google or whatever it is, even retailers are more informed, right?
Where I'm coming from is the difference between an individual and institution is on the order size.
India is more. India, an institution can buy, but can sell from the same account on the same day.
Yeah.
While individual trader can buy and sell, buy right now and sell 5 minutes later. And you cannot do that.
I'm from this sort of version. And the question here is the fact that there is information. Information-wise, there is information more than unmeasured is that there is no informed news that an institution knows.
Well, make that as I'm talking
about the fact that there is, whatever information available publicly in the domain, what's available for everybody. As an individual also can knowledge about that. So everybody is, when I'm making the assumption, what I'm trying to make here is that there is some news flow which is there, which only that institution is aware of. Like that kind of situation will not exist.
But I think you're making a couple. I mean, I see where you're getting at, but I think your statements are not exactly reflective of that. In terms of, first of all, that assumption that institutions and individuals have no digital information content, just true with to whatever things individuals and institutions might be able to see at all the same. There are 5 different quotes or 5 different prices, or different exchanges, different prices. Both individuals and institutions might have that information content, but have the expertise, the money to basically find out some modeler who would on a real-time basis be able to simulate those 5 prices and what is the most likely executable price in the next 1 minute.
Individuals can really small holding very quickly. Well, you will not be able to do.
Well, that is the other side. See, now what you are arguing is exactly the opposite of what you said before. That is the argument which tells you that information advantage, information analysis advantage, or analytical part of that institution's advantage. They might not at the end give a clear-cut swing because the constraints that they have. Right? So I have better information, then I can find out that which one is leaking. The modeling, so I have found out that this is the best price of all these exchanges. Take data. Okay, on that. But again, I can only do 500 trades on that, where my record is to 5-7 million. So see, that is the reason these things are not so clear as you think in the first shot. That other out of that same size thing becomes that with information analysis advantage, to come to a realization of that, this is the best price, where sometimes it gives an advantage that we are providing liquidity, but at the same time give you a disadvantage because there may not be enough liquidity in the market to sell that stock at that price. But then trading it only institution trading a particular size has to trade with another institution. It is only available with another institution. See, then neither institution gets any benefit being an institution.
So point is institution again is a collective mind, collective decision.
What do you mean by that? Collective. When somebody is actually taking the decision, it is always one single individual.
Yeah, that's what I'm saying. In case of individuals, say for example, there are 1,000 individuals who want to buy one stock, and the institution who want to buy 1,000 stock. Correct. Well, in this case, institution has 10 minds and other collective decision. They will come to a point. Okay,
how can you say that? How can you say that? Because
only one take the decision.
Exactly. The manual decision is always taken by. So you can see that he has an institutional investor or trader who has a lot more inputs to his decision making. Okay. So, but that input decision making does not necessarily make it.
Individuals might, for an individual, we will think I have only one person and I'll take it and go away. And say, okay, my risk is 1%. Say, my profit should be 10% and the risk should be 2%. So if we see, there are some individuals who are very high risk traders. There are some individuals who are very low risk takers. So they get very
That will be the same. The people who are advising the institutional trader, that is providing those inputs to that. How 10 people, one could be a very high risk group and another could be a very low risk group. And the second adjacent point to that one is that the level playing field comes because an institution, if he has to then buy or sell a large quantity of shares from individuals, because one institution cannot provide that, or individual cannot provide that. So again, he is facing those 10 different, risk and low risk groups that is talking about. So and then
there will be any difference in terms of cost of money.
What is cost of money?
Like individuals, we have their own opportunity cost. Whereas in terms of the cost of borrowing, because you will see that in India by investing, because there is a cost of borrowing is there. So there is of that, advantage of that. So if you see, trader will always be, the user will always have to in mind that at what particular opportunity cost they are playing with. So they are the slightly disadvantage.
No, absolutely no two ways. Absolutely. That gives them some advantages, but again, the advantages are again the time that if have to. So the advantage that you are saying, so that advantage tells them that this is the right time. So the cost of borrowing is going to go up in the next tomorrow. So do as much of trading today because you are getting the money at a low cost, right? So that provoked me to basically find out is why, which is my trade size becomes now a handicap because I'm not enough sellers into the market. So see, the same thing which is an advantage, in a second you can with this advantage. That's where the interesting finance is that it is so kind of dynamic that you cannot simply get absolutely. So this is about I think brokers, what they do, how they make profit. I think the business part must be pretty at least you would have a layman's idea of this one. So one of the questions from here. Rob, by any chance you can hit this up or get okay. Take another question from here and let's see if we can make some. Very good point. It's a kind of a more theoretical question. Okay. What is best execution? So responsibility is best execution, right? What is execution?
So in the morning, suppose requires to buy shares of company X by the end of the day. So best execution at the end of the day would be the feedback. Okay, and see where your exact position. So your total 1 million shares if you plan to buy.
So every broker will do the same thing. So how do you say one broker is better than?
So interesting, 1 million shares cannot be at a time. So you need to.
I know, but how do you
At the end of the day, the VWAP would be a regular value, the billing of the day would be at some place.
Okay, let me help you focus the question on the. So, how do you basically, at the end of the day, will say that broker A, and you have given that same to your two brokers, and you given them that is 1 million. So you divide your not. How basically at the end of the day will evaluate the performance of?
So if there are 30 days, 30 trading days, broker A, broker B, we have shares each day. Look at the weighted average price at the end of the day. And look at the one which has what price has been brought by broker A and broker B, and how many times the person has got, got a good differential with respect to weighted average price.
You would look at it as, if I'm taking a trade decision at the next price, if I'm saying, this is the price I want to buy at with a limit, right? I would look at the group who has bought it at a better price, for me. What is better? Lower price.
What you might think is the right price, market might not tell. So generally when the orders are given, they tell, okay, or it's between, if it is at 100, it's between 90 and 110, I want to buy. And within that, the broker has to execute. The second point is with respect to weighted average, how below and how.
We work for a brokerage firm?
I was in Morgan Stanley.
Some brokers who use VWAP. Our question actually is, how did you come to know this VWAP?
What's pricing?
Yeah, how did you come to know this? See, I am sure that most of these people know. Do you know? Yeah. Everybody knows VWAP. Okay.
I feel that, implementing software will be the major criteria for choosing any, broker. So when saying that I want to buy this one, how much, what kind of implementation software is coming up? So, and the is for sure the VWAP price that the broker is offering to the institution. And the other thing is that how technological, the broker can provide the infrastructure to company or the trader, so that it takes a decision quickly and their execution also happens quickly.
Yeah, see, that's not. I think getting a little away from the point that.
Because customers, I will look at only two things. One is should be able to fill the order consistently, and since it is on my budget order, I don't want to pay.
This point is very different from the thing you were saying. So, VWAP is based on certain assumption about the performance measures is based on what guy's target does he want to. His order is first price or getting it at the right price is the
and to depend on what is market right now. If it is the very market right now, the volatility is very high, you just want to sell. If it's a normal market, it's along, I want a good sell. I don't want to pay better. So it really depends on the time of the market.
And not time you see. Now, how much leeway would you give it to the broker?
So generally when the order comes, suppose the order is for 1 million shares, if the present trade price is let's say 100, we will ban. The one who wants to buy, will give a ban to the broker that this ban will, I would like to buy. And if, or maybe it might also be in the case that if it in case it were to come down drastically or significantly, you can still further work on the size of 1 million. Like if it comes, maybe you want to buy more, maybe it goes up, you want to buy less, whatever. So accordingly, within the time, what is transferred at the end of the day, one is within the band. That's my requirement as a broker. This is how best I can get them the price within the band. So in terms of being within the band, and at the end of the day, whatever volume weighted.
So if you give a band, so see, in that case, if I have a broker and in a very, very tight band, right? I don't have to watch for anything else. Actually, if the broker accepts that band, then so his thing is true. Alright. So in that case, why I always choose a band which is so thick, hardly performing that band.
I just 5 minutes 100, nothing else.
So you can see that that you can see that so that
that's the case. I think so.
right. So why wouldn't an investor? Why wouldn't they actually they would not do that? Give him a very tight band.
Execution.
See, price performance cannot be. You cannot take the price performance as the measure.
The right execution means getting the field on a rate price.
So liquidation shortfall.
I am a big fan of that, but only thing, the implementation shortfall, there was the whole idea came from one paper by Ferro, yeah. So we got this one, but see, in that, I love this, but very little academic content in this one because everything is kind of an ad hoc and nobody knows why implementation shortfall, what is the theoretical background behind that. The reason it is very difficult to make that implementation shortfall make a strong case for it on a theoretical ground. But it has been many in the industry they swear by that and they love this concept, but they not make a strong case of that one because again cases are always given by some academic people and this is a good way to go because they are not objective about shortfall is also much more complicated than VWAP or TWAP to implement it because again you have to find out the market impact of, and that is where the thing market impact depends on which function that you take. And which function does it? So, every time you run a market impact function from some variables which you think something which approximates the impact cost. One of the YMC. When I taught at IMC, one of the it was a 2006 batch. That was absolutely the best class I ever had in, and because in that around 20 students, some came to know of that Wall of Fame or Wall of Honor roll students. Out of these students, of the topic of the 6 honor roll students was in that class. It was absolutely full of real star performance. So in that class, one of the things that they did was one of the group there was a requirement of a research. Every group actually did a real research paper. Got the data, ran a model. That group actually got a market impact. Market impact function. And, I think there were 5 or 6 groups or so. Groups of their groups paper, I think they at least 2 I know for sure those have been published in some journal. I do not know which one, but they have been published. And one was in the run, and I do not know whether they pursued it, but they wanted to have it published. When they did a market impact function, they found that by just basically taking function on their raw value, so say supposing spread or say supposing volume adjusted by what is called in the industry as excess volume. So you take the average daily volume, so a part of the average daily trading volume is your trading volume for that particular company. If you take all those measures, by instead the raw values, if you basically make it to changes, then the function specification changes. If you log to it, the specification changes. If you add, so what they did is basically they did a statewide regression model in which that every alternate time I add any variable or take out any variable, how much more power does that equation have? I find they are all over the place. So that's the reason it is very difficult to come up with a good solution. This is the holy grail of where most of the people get completely lost in the topic. Models are different from one another in terms of some rules and protocols. These rules are embodied in this thing called how can one submit an order? Right? That is to submit an order. That is the screen that the trader sees. Some may say that you can do a for buy, specify a specific price, or say that I buy it at a price less than that. That means I'm giving you a max. Will allow you to put a range that I will buy it within this to this. All these are then some will give you traded orders you can make, stop loss, or this one I think it is called indexed. It says in the next one, possible use of an index limit order. Can you think of this? Index limit order is many of you know that, right? So limit order is you give a limit order. So what it means basically both the quantity and price figures to specification you are giving. For that reason, the chance of that field is closer would be right. But did that be on the link of a index? So I say that buy this stock for me, and usually you can think of it, it is going to happen for one of the in component most likely. So I would say that okay, buy this stock, okay, in index, the index which has all those regular stock in its index, it goes up. Like this one also. Yeah. So that is a very sophisticated, order type, and it has to be the broker to understand what is behind this kind of a sophisticated which client is trying to achieve by doing that. If in the think of what would be a good use of this. A good use of this would be that you think that Liquidity would be a good example for that.
In terms of if you have something like a 5-stock linked structured product, debenture, a stock wherein you have identified 5 stocks, by identifying that they are, say for example, Nifty from Nifty taking 5 stocks and have a debenture with a floated. So all are not correlated. So at a particular point, you want to buy some two there, and you want to sell some.
Yeah.
So, yeah. That so as to maintain the balance. So
that will be one. The other one, arbitrage, yes. That you want to basically have a position in a security related to this project. So want to basically have a situation that already the importing somewhere. You already hold that, and you want to basically make sure that the indication moves too much away from what you expect it to be. Portfolio that going to prevent from the right. So supposing your baseline index is Nifty 50. There's another index or another sector for something like that.
What I will do based on the index constituent prices, I will take their own index.
Yeah.
And that I will compare with the
So instead of that, I was thinking that you don't have to have an index with a constituent. You can just take 5 of those stocks.
Okay.
And then you either that exists as an ETF or it exists as another fund somewhere, and you can basically create it on the basis of if this one goes to that level, then buy some of that other fund or that other portfolio, so that. So those are the kind of what is the possible abuse? Can you think of an index limit order abuse?
In the index to buy constituents, index rates. Then I have to push the index. That kind of circular.
See, it is one of the or few of the stocks are heavily weighed in any index in terms of market capitalization or something like that. You're rampant with giving debit on one side and being the other on the other side. A complete panic, and they would start selling off on the other side, right? So it's a very case scenario.
Is this an exchange order type or is this a
exchange order type? I do not know if all exchanges have it or your NSE or BSE have it. I don't know about that, but it's possible.
Yeah.
Index order? Not index limit order.
Yeah, index order. The limit order means
Bulk, that is complete constituents which you want to buy, right? That's the basket order you're talking about. Limit order.
You are buying any particular trade based on the index. Yeah.
You do that.
Yeah. It's because of those abuse kind of thing, and in markets which have some tendency to go once in a while, and I think Indian market, I think where was that, like the meta or something like that, a short meta or something. Yeah, that guy ran over completely. I think in markets which are not fully, which doesn't have a whole lot of both very oversight and say big of kind of unsophisticated investors. See, these kind of things are very, very possible, and so it is. Those you will not see that it is only in very, very controlled supervised markets. That's when you can see kind of an instrument. I would say that you're not going in a, but in case if
exchange?
Huh? To be exchange, you can see for that. You can also see if they have it in Euronext, I think.
So this is probably a strategy in itself.
I mean, any limit order, isn't that a strategy? Isn't that a strategy? Any order thing is a strategy. Only when an exchange puts it out, that means that strategy becomes a more close strategy. That means everybody, instead of one trader sitting down and trying to find out his own strategy, this becomes a strategy which is pretty common. So, the sell itself is a strategy, right? So, trading sessions, execution systems, trading systems, there are lots of, particularly aftermarket thing, that many exchanges are now different from one another in some of these trends. The third market, fourth market, those market is very, very common with the foreign exchange market more than the equities market, that they have a lot more, because foreign exchanges by definition means that you cannot deal with foreign exchange sitting in just in US currency, right? Foreign exchange means that you are dealing with another country, another market. So foreign exchange is very, very many sessions are a part of the equation, how price formation or price evolution is going to happen. So in which are more global traded, that means which one is their foreign exchange market now? I know here in Osaka, they one of them. Tokyo became a full-fledged stock exchange. I think Osaka became a full-fledged, yeah. So there is, and so if you look at Osaka versus opposing foreign exchange market, which on its own might be pretty big, but so you look at that to the German exchanges for foreign exchanges, in the Osaka market is only a lot more integrated, and with a lot more integrated, there the price discovery. So somebody would, if they want to basically have a swap kind of an instrument, and they supposing have two options: one to do it from this dollar to yen through, say, supposing Indian rupee. The way of going it, US dollars through Dutch mark and Dutch mark through euros through this one, you will find that well, with euro that example possibly is not good. If you think of like the other pound, which basically is stands for. So you look at it, that pound versus dollar, pound, and pound rupee, you find that there is a lot more traffic and a lot more swaps on the Japanese route, on the yen route, because yen is a lot more. So I think those are the things where trade stations make a difference, because how long and which market it has more. So, definitions and all this, I think just by reading it, you can get a sense of questions. First, take a few minutes to read and then if you have any questions, I will answer that. But after that, look questions and tell me that, what are your thoughts about the questions, or one of the questions or both questions.
All three questions you should be
okay.
And for the question of
okay.
our
That's a very
data man. You
Yeah.
from that word of
it is a very important question. So what do you want to take first? What are the arguments for and against around the clock market? So for and against.
So it's good, right? Because we need to trade at what time, like depending on their own convenience. First of all, that thing. The trading decision can make a decision in any time. It's not that almost a event has occurred and that is not counted in price.
Why don't you have that same rule then for time? Why the break there? Well, like office hours, like 24 hours of the day. So take the human tendency off from the market.
Machine driven, right? Market is like if you have an electronic order book, it's more like a machine driven market. It's not it's a trading floor or like the open house system or something like that. It's more like a electronic.
See, you are blowing too much up. You are exaggerating the importance of machines in the market. It's still that.
It has to be.
Yeah, that's true.
It should make real sense. Almost all exchanges have lunch, except almost exchanges have lunch.
So they are reducing the lunch significantly. The recent 6 months back, Singapore stock exchange reduced the lunch from 2 to 1.
So what
is the impact on volume significantly?
Yeah. So think of it in start from the other way around. Like doing. Is it doing something wrong? Is the lunch break the reason or the cause for any what is that? What is the effect of that? To be able to argue, whether keeping it. Exactly. Is the effect of having it.
Typically, when we look at it, FX markets, OTC markets are completely around the clock market, right? And then when we look at it, onshore and offshore markets, completely offshore markets, stocks 5 to 5:30, 5:30, stops. So if you want to trade it, you trade it with, the offshore guys, who might give you a more demand per INR. You're having a 5:30, right? But because even around the clock, you have a particular working time or whatever.
No, right now it's more global. So let's say US guy wants to trade India market. So it is while they are sleeping, isn't it? So even if there's ETF, India ETF, so they have to hedge it against some rupee. So for it should be round market.
Very high. So particularly of these round the clock lunch recess or opening closing time. If you look at this market, in any geography, all of them should have similarity in those. The only differentiating factor across markets should be the time zones. Because why I'm coming to this is lunch recess in Hong Kong, and whatever is in the order flow at that juncture would be, say for example, somebody who wants to trade from into Indian markets will be.
Look at that. Earth is kind of doesn't that sense that if you are trying to find out one common time zone where it is going to be, all the markets are going to be open, that is not going to be more than 20 minutes?
No, not common time zones. One was any of these are posed by man, whereas the time zone is natural, right? So any of these parameters, if it is going to be there, like round the clock, lunch recess, trading points and suspension and everything, they're common across.
Yes, how would you make that common across? It's by the nature of the art, like you cannot make it because there's a moving thing, so you cannot, how can you put all this, if it is globe, and I feel like, how can something come at one more angle?
What I meant was, if it's going round the clock market, let us take round the clock market, so all the markets is better if they are round the clock. as in it's all exchanges are or predominantly working around like now.
Oh, so you're saying that okay, it's one side. Okay, so you
last resist then
every market has that. You just pick your what time there. Yes. Okay.
So somebody who is trading from some part.
So it's not a good idea. In your point that it is not a good idea that one market has
a large resist,
other one doesn't. So you are taking up this is in legal thing. There is this whole thing called there's a very strong group of researchers who call this thing called convergence theorem. So these are all rules giving this trading rules and all these things. They have a global convergence. And there is some people saying that opposite side say no convergence doesn't make sense and divergence is the way we should be because that way the world has performed. If you performed so well in the last 2,000 years or 20,000 years of human history, what's wrong with that in the 21st century? So see, it goes both ways. But I see your point that and you are not the only one, you are not the first one to make that point. I think there's a whole school of thought in things.
So the main thing is the reason behind this is the undue order inflow or outflow, whatever is going to happen. Because these restrictions mean that in some markets and not being there in some. If you take Hong Kong and India, Hong Kong has a large resist, we don't have. So order inflow from that part, say for example somebody is trading out in India.
You could argue it this way that let's say somebody is trading Hong Kong and India. So if Hong Kong goes up by this much, I'm doing this by this much. So that Indian market starts dropping because now there's a large resist in Hong Kong, so nobody is doing anything. I can offset my position. So that is a risk to my strategy.
It's to your strategy. Think of it the person who not. So for every one person who wants to use that strategy, there is 1 million who doesn't do that strategy. They tell you convince there are 1 million people.
So for the equity market, when the investors are coming from all over the globe, which was then zone you are working was to match his time zone as well. That's the benefit for the market, and there are two benefits that you can have participation from the and second is that whatever information comes in, that factoring the prices very quickly. You don't have an extended fluctuation. You don't have a very classic example of a present scenario. After the SPE data, we had a S&P US markets future down around 1.25, and we are all close. So we'll all open on maybe react to it, and we'll open around maybe 1% or whatever, across the market.
You can't take yourself.
But like mindful of the fact that there's some data which is there, so I want to do any offset. He might be a participant who may not be out of it, but you should give advantage to people who want to do it. So from that,
see, your argument would have been much more strengthened if you had seen that have similar bond or tend to have similar bonds at the market. That means that we see in just in one country, USA, between NASDAQ and LSE, we say the volume of the day is 50%. In stock exchange, which means at the end of the day, again there is a stock, but in NASDAQ there isn't. What is it basically defeats all your aims, right? That, opening and closing times are really that bad that it is good market in terms of the volume is somewhere getting back, in the other one it is not. So what do you do? Things are going to be just as erratic as it is now, right? So that is the argument against that, why then basically for change, artificial changes do not impact. On the other hand, if you look at the lunchtime slot in one, okay, that is again, it is true for most of the markets that I have seen. In this time there is a, so for that lunchtime extension, that means, how much before after lunch that thing kind of model, yeah, it is not clear. Some people take it as the same argument as Hort. Hort was imposed after the 87 crash. This trading Hort is going to be the panacea for everything. So, Hort it, let it come back and, we'll do that. They're not in the house. So we do not know exactly that there is certain amount of if a system is changed, it will back to that one. What you do, people eventually get back to their normal way of working, but that normal is what they see as normal. Not you or regulator or somebody sees as normal. Now, what they see as normal, how do you know that? What will function? You know that, after lunch, lunch is what people mostly expect, and surveys prior to that, not sit down and 45 minutes after that 30 minutes that people try to get back to it. How that is it 30 minutes, 45 minutes, or is it 15 minutes, 20 minutes, or is it 25 minutes or 2 hours before and after? So how do we know? That is not telling, right? Historical, all the patterns are telling that, in NASDAQ they do it, NASDAQ and NYSE they do it in 2 different ways. So it ain't traders.
But in most of the markets, like you.
It is not at all. In the Indian market, in the futures market, I think there is a friend of mine who just saying he did this thing on the market with the data that we got from which is the NCS. Is that the company? Okay. Started from there. The volume curve is intraday volume curve is completely swinging out of how to explain. I do not know. They have this for gold, oil, silver and gold and zinc. These metals are completely 3 different elements. Well, if it is global, obviously a global commodity. How would you explain that zinc is different than gold and silver, particularly in a trader's mind? Why all of a sudden for gold is doing 3 p.m. Why there is trying to find it that whether the here you have extended trading hours. So I think it goes up to T1, which is what 9 or something like that, right? So we thought that after there is in the regular pattern there should be the U, and after that because in other futures market there is the U, it talks about that U because it goes at 5. So over here from 5 to 9 it goes which pattern of the company? No. We don't know how to explain that. 5 to 9 not between the 4 metals. That is all the problem. It is very difficult to understand that, because history possibly there is a thing about this. The reason for this kind of models came from the understanding that it's not short memory, and short memory in time series analysis it is basically so one gives you a version that is short memory, and that's all we want. That you have to just basically it becomes what is called a obvious process, like just this last bit information gives you. We do not care about the rest of it, so it's a non-coding process. So stage of that is once you go beyond one, two nested one of 2 and 3, or 2 and 1, or a nested one of a combination of 3 and 5 and 19 and 26 and 50. All are equally meaningless to us because we do not know what is the meaning of the 50 lag in one case and the 50 lag in the other leg. Why is that thing will have a that kind of a memory? There is random. Then it becomes pretty, and it's the same thing that so something does not give us the very simple rule what to follow. There is no Okay, we still need to discuss the last point that is so fascinating about, right? So, hope this person or it is automatic.
Actually, you are logged in as Anupriya.
Oh, I'm okay. So you just can I close the thing? Okay. Okay.
So are they downstairs? No, they're outside.
Okay. So who automation produced the exchanges? I haven't talked much.
Actually, I'm very new to trading. I just today.
Oh, that's in this. Where huh? Oh, you okay.
Yeah.
So, where we started trading?
I think this is my 4th day here, so I don't have really much idea about trading, but I'm just trying to get a hang of things, what exactly. And the main question which I really wanted to ask was that how much can technology replace the human mind? It's just these are the very elementary kind of things.
Yeah.
Not
people hang on to something. See, the whole thing about that nobody knows any better. We do something, just because because one of the things that has been doing, taking out some of our mind space is that the technology, and particularly just computer technology, hardware thing, is the thing for that reason. It is easy to start a conversation on the basis of that. That is not for anything that is happening. Why do you get married technology? Why do you get short of technology? Why did people now have a more of weak technology? So that's the kind of thing. It's pretty mindless of the without finding the real need for anything.
But here, like my view of this technology is for that it can be the credit. But the initial work, the analytic work has to be done, and thereafter it can be transformed to the technology. But in that, when we see that the kind of volume that is happening on the United States or MISC, almost let's say 60% is because of the machine. So the festival is why the analytic work is fine. Like of course the requirement of the human, of course that's required. But finally the execution side, when we see that how it transform execution. We said, the machine is taking a lot of, is going so much ahead now.
I don't know what you mean by
decision is taken by you, right? Execution, the system is doing. Rather than, I have to buy and sell, that is what the system is doing, but trading decision is taken by you.
And that would probably form the basic reason for market to close at some point of time, because you want to retire at some point, right? You cannot go on and take decisions on your behalf while you're keeping and you're not monitoring the system. So that's probably the reasons why I would negate the round the clock market system, because some people have to monitor, or some person has to see whether the machine is doing is right or wrong. Something of that sort. Probably it gives you a latency or the time lag advantage, something of that sort. But to a large extent, it's limited back only, I guess.
See, that volume thing that you're saying, I think to solve right before coming from that one, is that, see, this volume thing was fewer, more technology, was this complete marketing genius of these companies. Trading companies, when they win mid-East about their money, their pension fund account to the stock. Now, what the rationale was the pension fund. These money managers who are doing the 30 years, have some training, some understanding of finance. Well, they're slow movers, they don't do too much. What you take out your money, put it into it, and initially you see a success, because when the whole market is, any stock that you pick up is going up by 20%, what is the chance that you will not get 20%? The chance that you will not even get 50% on a cash stock. Exactly. Now, the electronic trading companies basically, all these E-Trade, stock trade, Ameritrade, all these things. Think of it that if they were, whether you are gaining or losing in a second, yes. No. Because every time you are trading, they are getting a commission, right? So during this 4 times the volume thing happened, so it almost went from 1995 to 2000, 1995 at the end of 1990, 1995, the volume was 200, 300%, 2 to 3 times, or even more than that. So, at the time, obviously some people lost. Because again, 2% transaction cannot be a law. But who was absolute winner, no matter changes and the individuals, right? See that why all companies, and guess what? new companies which came up with electronic trading, they just kept to 20, 30-year-old guy. Come and sit in front of a computer terminal. He has full control over it. So you ask him that, okay, I saw that, so it will be the typical statement that, okay, saw this, he came in, logged in into the computer, and they showed me a chart that for the last 3 trades, okay, prior, it was all carried by a buy. You do not even see the buy. So you see that the last 3 market prices were all uptick. In that 1 minute where these upticks were there, what fundamentally changed in the last 1 minute for that stock so that to give a high price? Why you give a price for the same stock 1 minute later? What do you do?
And that after me, someone will pay higher.
So if it is that after this, somebody is going to pay me higher, if that goes on, when you will pay for a stock? Basically, everybody was shooting for the infinite. And you can see that how stupid someone could be in thinking that. So, then this infinite fractions happen, and who is the percentage of that infinity? Percentage of infinite is infinite, which means that's why all these companies came up all almost at the same time within 2 hours, 2 years, all these electronic trading companies, and they to basically trade. They did around 30 days, no fees. First day. See, you do for 30 trades. Okay, you are hooked up to the system as if like a drug, right? You are saying and you are showing it to them again because of that notional profit. You bought this stock today and you saw by the end of the day it has half by 20% again because of these people traded after you, not because of any change in anything. 20 people traded and they went on way. So at the end of the day, even without selling the stock, you think that now you are 3 times more richer. Whereas richer is because the stock has gone up.
Now, even more, there are a lot of misuse happening, right? One classic example would be CFDs, the contract differences. The electronic, trading platform which people would offer you, right? You can turn currencies, commodities to.
I'm sorry, I'm not aware of that, but it is visible. The same thing you will see now. They have seen. I am sometimes so flustered by some of these things that I see. Foreign is one of the most complicated instrument. Again, it is much more complicated than equities because equities are still a domestic market thing. You can have some sense. On exchange, you are dealing with the sense of macroeconomic situations. Now, the exchange rate is going to be between India and say Yugoslavia or India and whatever Germany. That depends on this how Germany's part, which is rest of the world, how their economies work, how each of those individual work with respect to all the other partners. So it is basically you are talking of understanding the whole sense of the entire world economy.
Yes.
Even now there is a company called I think fxtrading.com. You'll see that sometimes it will pops up in your thing. It was to the thing democracy. Now this is very tempting for somebody who anyway has this bloated ego sense. My most 20 years old have. So I think, now I can trade even foreign exchange and I'll get do this thing. Now what does he know about it? He doesn't possibly know. Can I tell what are the 134 countries in the United Nations? The name, which is the last country which became an independent nation. now you know foreign exchange trader. You know all of this now. What we are doing, we are basically all promoting this company called FXTrading.com, which is basically get certain amount of it. If you
one more sweetener as well. For first few trades, even if you lose, if you back the money, you need to pay 70 at the market, you know, trading, whatever.
So that's been the situation. You know, it has just people are bought into this market, right? It has nothing to do with either finance or technology or any of these things. So say we're saying that, you know, this guy, I am a big technology guy. Asking to basically, if you are that good in technology, can you write a simple code, on Visual Basic, to do that thing? You know, like how to even do Excel sorting. This guy would not have any clue, but think that he's technology now. That is the mainstream of technology that he's trading online. So that is his own technology. See that how superficial all these things are.
Actually, it comes about like FX trading. No, there are other companies. I also tried open implementation also open a demo accounts with them. And I thought there are all the codes that to me are fake. I so what is the trade you are based on what they work, the unit that feature they only say you will start it and they only do this. So you have criteria selecting people and it can be anybody. So what they want is you go to meet those criteria, mathematical I even put the test. I just wanted to know because I want to interact with that. So after that, once you're in, they give you 3 months training. So what is the training all about? They will give you one share. So consistently, as and when you churn that share and you say 10 times you make money out of that, say 7 times of trading you make 3 times money or 4 times money, then the 1 becomes 5. 5 becomes 10. That's the size increases. Once you consistently over 100, 150 years, they by the time you are open your account, they will give you the account, so you have to pay for them. Right? And keep on, so that the ratio was something like 80-20, 80% of the profit is yours. So they highlighted is about a person who made 30 lakhs in 2 days and he traded assets. Right? Okay, so this is what the rate is used. So when it's there, it was Saturday, and the entire building, like, it's a huge complex, it's completely deserted, but in that particular building on the 4th floor of the offices, till downstairs, all other people from parts of India were from there, right? And the thing Vivek was about it's survivorship bad. Only one guy is shown. They do not correct people. So the loophole was, in case you don't make money or you lose money, then initially when you stop, you have to pick amount and then everything is taken.
See that, this whole thing that some of the other, I mean, if you go by this kind of this, there's a famous university called his name is Big Chani, something like that. It's a big name, Big Chani, I think that's his name. So with some other people called these fads and fashion markets. So if you run after these kind of fads and fashion, it creates that image of a doing something. And you want to line up 5 people chasing that. See others. So the whole thing is about that creating a sense of the first 5 people. How superficial all these things are. The biggest investor that I know of, Warren. So, computer. Doesn't have a computer. He never has used one. unless you give him any accounts or any reports on any statement on other than in hard copies, he really had a loss. But I'm a big people I respect for whatever reason. If I see them talking, sometimes they come in for a letter, or sometimes they come in for a decision or something like that. I always go with that. But a few months ago, see, I again know if you are aware of that, but X is no longer the CEO of Microsoft. He has given up his CEO position to be focused on the Gates Foundation, which no wonder it has now the world's #1 non-governmental organization in the whole world. So how it became #1 is obviously Bill Gates gave most of his money. Also, Warren Buffett most of it because Warren Buffett is doesn't have. So both of them came together to a Columbia University. The school hosted a little thing about and they came in to talk about finance and many things. You see the clarity of this guy's thought. He's 78 years old, Warren Buffett. You can still see the clarity of his thought. Everything that he will say, but how. In fact, he was talking to one guy about his Columbia University graduate, and he said that how much your degree worth. Immediately made it think, okay, so this is the present value of the free cash flow. For you are Columbia University graduate, this is the money you can get, and you are obviously assume that this is going to have this, and this would be kind of the growth pattern. He immediately did a valuation of what this guy is worth. But compared to that, think of the money they have paid for this, and the difference is the NP. So I will invest you, and why I will invest you is because that NPV. So this guy is clarity of thought at 78 years old. Yeah. Just think about George Soros. Like, if you talk, if you've ever seen his interview anywhere, he created a single of these stupid arguments, superficial arguments, but you have to see that in terms of while the difference in those two are, while Warren Buffett has a keen sense of these business and company valuation and stock valuations and all that. Soros on the other end, you have to see his expertise and understanding of the economic conditions and global things. I mean, he's crystal clear. I mean, translate any of these things to actual trading decisions. I mean, you can see that just from there. I think if you watch them closely, you are not looking for the bites like technology or those kind of things, and you can see that how deep their thoughts are and know and what is the reason behind their success. As what George Soros think of this euro crisis. You think of it, 10 years ago he made money because of this euro crisis. 10 years ago. So now the whole world, the only way he was betting against this, that this has to come because of the conditions of. So the entire world, when it was going in one direction, one single person put in the wisdom of the rest of the world. And later, so this is where I think is the to have a real understanding of and kind of judging impressions and how you know and how much you understand. These are the benchmarks. I mean, most of other things are pretty. So again, the pieces that people just throw for reason. Each time that the fake about any of the guys around, I mean, including many of you might actually think that, oh, what a genius he is in 26 years old, has got rid of $1 billion and all that. He's telling, we go, that Facebook really doesn't have a business model. Absolutely surprised that Facebook actually made money for investment in the long run. For a long time, these things were pretty much, in their own, nobody cared. They were just loading up the value because of God knows what. When it comes to an IPO decision, and because of the market has become pretty high on this one, the companies which are now trying to evaluate for the IPO, they said that really speaking, it cannot command the price, close to what Google or any of the high price flying. There is nothing close because there is no business model. See, you would not mind putting in your whatever your sad face on your Facebook, but if business cannot run on giving this kind of frolic, visual thing, that cannot be where is the revenue from that coming? As Facebook now says that every guy, and they have what 700 million or whatever million, so Facebook, people run the thing network. They give $10. How many 100 million people will think that they would remain in Facebook? Even $1. How many people will remain? So where is the revenue coming from? Having it for fun is one thing. Because I want to invest in a company, I have to see not how many members are doing it for fun. I have to see where is the revenue coming from and where is it coming from. Yeah. If it is advertising, how is it any better than Google? No, come on. Away from the point. Is advertising, that is how many people you can get it to. Why is it when Google or Yahoo or CNN.com or any of these? Having 700 million members does not mean that those 700 million members are tied or bonded to you in terms of your advertisers. The reason people say that, because I give you. Another model.
Oh, don't you think that one is being addicted to it for a number of years? Then ecosystem in its own. It's a basically behavioral pattern of the participants. Because now I know the people who are even details of their own personal life. But now on Facebook, they share everything. We just study what they were doing, all with photographs and everything, information.
And as soon as this happens, you see what happens? Now Facebook is on trial. There are hundreds of cases now in Facebook. Either information which is causing them trouble, there are so many. Who is going to pay for all this cost of litigation?
Well, it's definitely part of the there were some issues with the privacy also.
Right, exactly.
Yeah.
See, that comes straight back to exactly that last question that we wanted to discuss. So any information that you are providing to Facebook, information and what is the protection? The commodity that all these things are selling. I mean, what advertisers are looking for. Is that, see, how, I do not know over here, but how the US, this is, that's what you at the beginning that I have this startup company, FenQ. So as soon as we registered this company, public information. Registering with the state becomes the public information. The companies registered, public this thing previously about the internet and without competitive policy would have produced every 3 months or every 1 year a list of companies. They have a green book or a blue book, and now they do it on. So it becomes public information, right? As soon as you have this public information, are you flooding of services, right? Because see, as soon as this becomes public information, the company will make sure you could sell products. They can either monitor each and every register to who are their potential customers, or alternatively what they happen, because these are happening on almost a time space continuum. Then a company which basically collects that information, puts it in a database. Just Connecticut, 20 new companies registered in the January. So there. So by town, by all the information that they get, they put in the database. The database is what they sell to it. Right? So you can see what these marketing companies, what their whole business is. Selling information, selling information. The same thing as Facebook, that is the same thing as exchange. There is a question that if that information, you just ask it like that, is information like that? I have filled a form and registered my company by I have agreed the public information. When I look at Facebook, where is that it is? That is what it is. So if it is there, they make it clear, and it is there. I tell you, you will fade out just because of that reason. We want this public information, all this information being hit by a middleman, sold to businesses, and these business houses call this guy every day. If they are sleeping or they are staying, that seriously people think of doing something for fun, for getting
the classic example, other example is especially on the retail category, right? Earlier when the brokerages started off coming up with an online, trading, especially in India, we came up with sophisticated, before your simple form, URL, click on it, you don't get the real-time streaming code, and it changes in every 1 second or whatever the refresh, right? There's a bunch of the guys who introduced, who had up with, the ones like E-Trade or Ameritrade, and they came up with the concept of giving a GUI, which is an easy page wherein you can see the streaming code, you can do chart stuff, right? So I was in late 90s, that online, all these companies had something like every month you need to pay X amount, 1,000 rupees, and then the brokerage, you can be assisted against brokerage. But right now, it's completely free. Like before it was like, when you look at it, they would charge money. But now, when you look at it, now if they go back and saying, you need to give a fixed brokerage for money, nobody will leave a buy.
Yeah, because they have got customers who will pay.
And again, the same thing goes with emails as well. A lot of companies who started off .com companies before they used to give free of the USA.net. That's a classic example. Before Google, whatever, when Yahoo started off, these and this company, when they made it as they're not charging much, $2 a month. The companies know it.
See, there is a long time ago when I was a student, one of the small case or examples that I was very intrigued by, and so I remember it so many years later, was what is the demand function? Function demand means basically it is a relationship between price and quantity. Okay. So of water. So see, in charge even 1 cent for start all their water is now we are using it so much so than they need, but so it is a kind of a very much two polar ends. Either you pay or you not pay. I decide on my quantity used exactly on the basis of whether I'm paying or not. So if I'm paying, I will pay. If I'm paying, I will. That's the kind of thing. So in occasional interests for that reason, that activity rate is like 98%, 99% fair, right? Because of that, everybody basically thinks of clean application. Seems very entertaining to them and entertaining to them, but with no revenue implication. And to have a business, you have to have revenue implication. Otherwise, no investor would be interested. It might seem like a fun project, but nobody is going to put in money for that. That's what English is like. Okay, who owns the information produced at the exchange?
Exchange.
What information are we think we are?
The contract forms. Because actually we see that the exchange charges is this data. They have this data and which is this.
The fact that they said, we take that as an evidence of that they have the ownership of it, right? That is
Other people cannot.
No, even for any permission, if you want to use their data or whatever those, if theirs is the source, if you do say, let's take an example, if I want to put it in the public domain, right, I need to take the permission from that, internet or wherever it is. Right? You need to own by them that want to take the permission.
That is the case. If I want to put some, some code that is generated by the exchange, so I have to take the permission from the exchange that use your code on my site. So then it will be taken from the exchange.
So again, you have to first clarify what it means by you own, right? Because there what you are saying is third party is your access the information that you are simply delivery of that. So you go to library and you have a Mark Twain's book. Obviously, don't go for copy about from Mark Twain where the library has the copyright on it. Do you? You don't mean the library actually owns the copy to the book? And by owning copyright means basically that is ownership. You know, so does the library own the book?
No, but very, very interesting ideas, right? Using that book.
So you see that the thing and giving somebody a restricted right to basically support somebody to use it. These are completely two different things. So now going back to the thing. So I think I was now convinced that just exchange gives you that doesn't give in the ownership to that information. So when you think, who then do you think owns the information?
There it is. Participant.
Okay, the participants. They own the thing. So we have to let's take the book example again. So, information content in the book is right. It is the quiz giving the order.
Okay.
Right? Does it actually have the ownership of the
Same way, right? The exchange is publishing the data.
Again, exchange is publishing the data, and the book publishing the data is not the same. Exchange, book publisher publish the data. He gets the same thing every time I publish a paper for that reason. The same thing that do that, is it for a trader?
You really do that?
That is a case for many jurisdictions that these change data. See, why do you think it took such a long time for changes? This data it is pretty much for academic institutions who use it only for for non-business, non-commercial purpose. I think it is still changes for that thing that they not sell the data as it is coming to business. So see the implication. It's a very, very deep implication. You money manager, you company some money. Know how competitors or how the other trade market they accept. Okay? But this exchange data, complete entire set of it. So I know my competitor A last Monday bought it at 9 o'clock. How would it be for me to exchanges still cannot do that?
Because it's the counterparty data, right?
So you can see that the change, even if you do something, they can access the data, but they do not have what is unencumbered ownership to the data. So that would require ownership is it requires a place permission data. And where shareholding or introduce of the data, which means what the answer to this question possibly say that it is a mutual ownership or exchange the data in terms of how much they can. So it is not easy as you think. thing, and there are many situations where this thing is going to.
Are there litigations going on?
Many. So
any outcome of any jury?
See, the problem is that outrageous violation, or plenty of lawyers, well-paid lawyers they have. So that outrageous violations would not happen because they're very cautious about that. That's the reason the anonymity, even if they don't even take for academic purpose, because I have used data from academic from NYSC. See, from the ID will not give us so they will put blanket classification. Some of the ways they do their blanket classification is they make their own classification of data based on the program proprietary data. This is a data that means somebody working on behalf of another this is an individual data. So they will give you some classification of that. So first of all, a very broad classification. You will never get any details of it. And add to that data when they give it to you, you find a waiver form from that you are not going to ever use it for any commercial purpose and for making profit. So outrageous violations they would definitely not do it, but the one which basically either by casual omissions or by unintentional unintentionally if they commit a violation of the thing, and then those subtleties, those things where the outcome of those kind of litigation are consistent because of the subtlety of the one judge or one set of judges look at it and one way on the other. So
what do they want to do? There is also making money out of selling data is not very money business.
No, it is not. But
so how does and the data is in the position one way or other. Information when was
no, that is not true, and that is where the exchange things field of trade of high frequency trading or even intraday trading. You would not have, you would not be ever able to create a discipline or even anything like that short unless you have intraday data available to somebody, right? But intraday data is in papers and all that. What the public information that you find out is at the end of the day. How find out on the end on the base of the end of the day at the beginning of the day data? How do you intraday strategy? Now you are still dependent on out there to get the data right from the exchange. Right? Now the question of what of that data you get access to from a live feed. Again, the brokers who are exchange is just a association of brokers, association members. So get access to that live feed isn't because these brokers are the members of the association. It's not giving it to an outsider. I'm just giving it to my owner. Of course, I mean, if as an exchange, I have limited access ownership of this data, that limited ownership then transfers to the member. Every you will see that's one reason why you will find it that if you go to any broker, he has access to this data. Now you will have access to that data, but you would not have access to ICE data. So you will only be able to see it on screen. You will not have.
So level, you need to take the permission.
Data is basically you are showing it to the owners what is happening in the market right way. You look at that same thing as Bloom does for any journal.
No, meaning this data is public. Does that show that it will broad research and many particles?
Well, see, there is no problem with making it available for research, but where is if somebody uses it for money, how do you prevent that?
How do you if it is available free of cost?
See, in this case, when you talk about end of the data or whatever, some of that is available, something of real-time intraday data. If you are not trading with them, right, they will give you access free. Normally, you take a screen from the broker. He's not going to charge you anything, right? He's not paying anything to the exchange as well. But if you're not with the broker as well, but you want the real access of the data because they give the access.
You want the real time, but at least archive data.
Archive data, even a broker cannot basically, archive the data.
What is what's
you do not have the technology from any of the screen that you see from that screen, okay? Because live data feed, and if it is a live data feed, that means as soon. So live data feed means what? It's not like that. So you are seeing it. You are at this point, and the day is going like this. Right? So at the point where you are seeing it, you can see that, and you can download a print screen from that one. But data before this, moved on. By the time you are basically doing it, it has moved on. So you not basically you cannot archive that data. They would not allow you to technologically do that because you cannot simply the data feed. There's no way that you are archived. That means put that data, some
people are doing it.
No, you cannot. Simply. If they're doing that,
now what they've done is NSC or PNC, what they've done is one, normally they would allow the market vendors like Bloomberg or others to do that. They take money from there, and then they'll allow the redistribution to people. And redistribution, they'll have to pay exchange the money. That's one mechanism. The other, especially now, what they've done is, especially in terms of they're promoting co-location, right? To get speed advantage. If somebody put a co-location server, they start allowing them to store the intraday or day by day data. But they take the necessary.
No, see, the NSC only gives you. They don't give you. That is the big problem with the companies that I'm working with, and also for academic purposes working with them. See, what they give you is that snapshot data. It's 5 times a day or 10 times a day or whatever number of times a day. They give you that do not give you tick by tick on a continuous basis. They do not allow you to archive that, put that data in a format where you can archive it and use it for later. They don't. For absolute surety. The tick by tick, one of the problems that we are finding is that they go statistics. Okay. End of the day, at the production line, okay, 9:41 and then 0.00 second. They code. They code for this code came and okay. Then the price, quantity, or whatever we don't have. At the very end of the line, they are that quantity to market trading at that. And that at every line, even if you do it from the beginning of the day, from the very first transaction, from the very first code, that is not going to match up with the code they have. So you start from the first trade code of the day. Well, that means there are many trades which are
two which they give up. One is the broadcast speed, which you're talking about. This is tick by actual tick by tick, speed which they give it in terms of messages. So they provided a location to record that data. Which people?
Your messages, they record it and
see, I don't think that.
Because one of the things which we are with the speaking to NSEs, we are trying to get a contract signed with them, right? Or just recently got it, which is like co-location we can capture before given the permission in terms of capturing only the broadcast speed. What you're saying is the broadcast speed, which is like every 1 second, whatever you take the snap and store it, right? There are others that take actual tick by tick, right?
Actual tick by tick. That's what I'm saying.
Now, it started, giving the permission, but you need to take it. You take the permission from the, exchange. I'm not sure of, whether the brokers, whether the market data vendor.
If you're talking about the market data vendor, you have the official permission from this. You cannot take that as the standpoint. That's the reason for the brokers. The brokers, what they would get is, first point is they do not get the complete limit book first. Second part of it, even if they give you the tick data, first they would not give you that tick where it is coming from. See code that they give you, it tell you where is this code coming from. Right. They give you a summary. Instead, they give you all the, I think the lowest bid and the highest sell in fact of the top 5 codes. Okay, in one screen I know they give you the top 5 codes, but that one is on a continuous feed that you do not get it from the tick. So on the tick that you get the best of those 5 codes at a point in time. You get one. So it's the first missing chunk that you do not get 4 out of 5 codes. And it does not give you where it is coming from. Third is at the end of that, you will always find a transaction price and volume with the code, with the last code there. This is, and the explanation that I've got from this company that I'm working with to develop some strategies for that is that there are some microstructures. Basically, it is not only just limit order books which are there. There are some market orders which they cross it just because of being lucky or being some way or the other that exactly the same price, same quantity is offered. So there might be some cross. So crosses come into the total volume, into the total number of trades being transactions, but it do not match in order to understand. So in order to go. And is where, so they cannot give you the exact complete of the limit book and or in details because that will be violating.
This is what is exactly happening with the broadcast speed. Unless if you capture it with them in 4 locations, then you do. So far, I think nobody has it with Indian exchanges because we were struggling. So that we are, within taking the complete permission, as well.
And see, and then when you actually get historical data, you will see that they only possibly a little bit more, so that you will get a general sense of what is happening. So out of at least in the tick by data right now, you are at least getting the best sell. See, many of the transactions do not happen. Actual transactions do not happen either in the best buy or in the best. Possibly is a midpoint. That's where the market order is, and there is a loss is happening. That's the reason when you get all that data in that data form, data modeling from which you never be able to figure out was the trading strategy that led to this particular transaction, successful or unsuccessful. So they have enough tools in the box to the vendors that you are saying. So Bloomberg and Reuters also very get it. See, that's one of the reasons in the Bloomberg terminal you absolutely never able to archive the data. You have to have a complete. So when Bloomberg you sign up a thing with the Bloomberg, they will give you the you cannot write. And you have to have a completely separate technology. Again, has to be what else, and you can see that technology is not close to being a simple one, because what you are doing is in the terminal, whichever screen you are looking at, it is giving you a little here, little column thing over here, little small snippets of last price, this price. From that, all of those screenshots, cutting it into storage, because if you're basically storing as a data, how would you convert a graph?
And that goes so further, even our eyes will be
exactly. So that is one motivation that you would like to have it in the archive data. But see, again, archive that kind of a thing. If you see it on a screen, what is happening, and along with that, there would be all the Bloomberg news going to flow also. How basically?
Yeah, you go to Google, you can feel a and you can have an archive. So they for your monitoring. Yeah.
It's very rich
because some scholars like resolutions like you can already publish some papers and they can use to do the research and basically to make models. In terms of
I wrote a paper. I said I am AC. They publish something called they publish a quarterly thing called Money Manager or something like that. So I wrote a paper. They asked me one time that can you make a short piece on this one? I wrote a commentary. In basically exactly made that point. I said that in the segregated markets like US exchanges and all that, you can see the amount of time that exchanges put in, the amount of time and money they put to evaluation. You have to come up with a rule or a thing. Make sure that rule is right on target, it goes the desired end, and there is a post evaluation. Because when the trading halt rule was processed, I think it was in 87 that it happened, but actually the rule went in 1991. 1991, for 3 years or so, 3-4 years, academic basically, and because when an academician looks at it, he doesn't have an agenda, so he is going to look at it objectively, as the rule is working within the so everybody thought through this whole thing, and in 1993 this paper came out from this guy called Lee and Reddy, who said the whole purpose was that you basically want to call Liquidity, because that is what is you thought was harmful. If you know the thing, it takes within 30 minutes or so, the volatility of the previous regime comes back. So what is the thing there? That's right. So they say so every SEC regulation, every exchange regulation are going through that process. And I made that point. I gave several references that the Securities Exchange Commission and New York Stock Exchange both have what they call academic visitor program. For NSE, the same thing. Why don't you guys have some academic visitors who would look at your whole damn stuff and then can suggest some? I said at the end, by creating more interest in stock market, you would be doing favor to yourself, because there will be more people will learn more. People from academic papers, these are published in journals. people probably no more. Why do you think that Hong Kong stock market has, you compare Hong Kong stock market to any of the stock markets living Tokyo out, it's hands down no comparison, 3, 4, 5 times more volume than anything else. Why is that? Because Hong Kong on exchanges, you will see that academic papers are like up to the brim in terms of Hong Kong stock market. I think that creates more and more interest, creates more. I wrote that, and I think I was talking to this guy Ravi Amshman, and he, because he's very well known. In fact, he's much more superior, I guess, in terms of his credentials. He has one superior record than that of mine. I was talking to him one time. He said, I did the same thing I wrote, and I had it a couple of times with the NSC guys, and they all accept it. But when they go back to their work, again, do not. So there's some kind of a disconnect now that when they come talk to one of us, maybe we are here arguer, or we put out more thought out points, or because they are just scared by our presence and our shouting that they all agree to us, but then as soon as they go back, they think, that's another problem. Yeah. So I think they just shut us off. So this is about the you can hear this is basically where a lot of academic research has been done. In the next section where you have these amigos thing, I think we will get to that a little bit more. That's the operational and functional details of each of those. But you can think of taking one of the questions from here, and let's see if we can do this question. With this terms, inventory, adverse selection risk, deal spread, bidder spread, spread component. Familiar with this term?
Inventory basically, if someone is doing a market making penalty, so how do you keep it as a particular idea of trade?
Yes.
When they are willing to offer something that is then some particular price or quantity, so there is some inventory.
Yeah, I think it is a market mix standpoint that they have to give some entry because of the expected out of their. So at the beginning of the day, so middle of the day they have some in their hand, right? And then they have 20,000 stocks as inventory, and right?
There's something this particular something like a 20,000 stock quantity. There's something that it's their own bought share, whereas in the trading they accumulate this trade.
They had it right from the beginning of the day, or through trading they have accumulated. So at 12 p.m. They have 20,000 stocks. Right?
So this creates an adverse effect, right? If they are at the buy side and the stock is going down, so this inventory, actually affect on the profit side. How do they take care of the risk that they are taking?
Yeah, we're going a little, jumping a little too much. I think so. So at 12 o'clock, this is the position, and supposing there are only trading happens only at discrete time. It's a market buys and sells are put in together. There is the marketing is the number of buys is equal to total number of sales. Okay. So there are two more things that those there is option for the sales, and there will be two more between 12 o'clock and 4 o'clock in the market. So, and the next call, you see that there is a, you see that there is a, you expect to sell some buyers, so you could sell 15 units of units that you hold at that time. Okay. What is that? Now, more column coming up at 3 o'clock. So you are going to basically sell 2,000 units of your stock. You had a better price than the price you would have it at 3 o'clock. This is the better price. Better than sell this 15,000 right now and not wait for the 3 o'clock. But in the other way, that this price is not good enough at 3 o'clock, I'm expecting the to be to jump, being the seller. Wait for the 3 o'clock. What is the 3 o'clock the price? Then I start with the 20,000, which I know next day because there is a target, because last two options downward, which means next day in the morning also there will be a downward. I will not be able to keep position. What? So the inventory position. So inventory more to tell you that market maker's biggest problem is that he can anticipate we are out of stock. It's very difficult commodity you can think of. Today, I tell it either way at pound or tomorrow. Sell it at $10 a pound or sell it tomorrow. And either pound or $5 a pound. The inventory thing, and which is the thing that you said you have no idea? The components are see the space, right? As I said, asked today. So why does the market maker charge? So that even if you go to the market, is a price sell a stock that the market maker is buying from you, he's saying then he's selling that same stock to you. What is credit?
Here we don't have that. Here only buy and seller match. There is no market maker.
You don't have to have a market maker, even if but you see
to seller only.
Okay, so but it's the same guy who is here buying and selling.
Right. They are taking the market condition. Even if you account some commission or some spread, so that is what they are taking. Minimum can be offset. Is that trading profit? I mean, he's going with the bid and ask both, and so to make the difference.
Yeah. So you see that so both of you have actually touched on the two components. Would say what is point is that there is a risk. I am going to buy it from but there is a chance that if I buy it from you, I have to sell it. Yeah, I have to sell it later at what price?
Yes.
On the other hand, there is a chance I have to buy it from you because I don't hold the stock right now, and I think that the price is going to go up so that I can sell it at a higher price. So I have some chance of making profit, but that chance comes also with a chance of losing. Now your point is that if you do not keep a difference between the two, I mean, why would I engage in trading? So that engagement of the trade or the profit that I want to make because of just engaging in this trading has nothing to do with the risk component, because that risk part is going to vary from stock 1 to stock 2 to stock 3. But irrespective of whatever it is, your argument about that I have to make value because this is my trade, so I trade stocks by provisional service fee for that. So you see that provisional service fee, that component of the trade, it means the same irrespective of whether I am buying or selling stock or stock fees. All have different probability for going up in price or going down in price for the transaction. But irrespective of the risk, and this is price risk, charge that fixed rate running service. So those two components. One is really called order and cost. So stock which does not have any price risk, my cost to you would be my order pricing risk to you. Because there will be most stocks will always have a price. So that is basically, so riskier stocks for that reason will also have higher spread. So taking in one question from there and let's see if we can. Economies of scale dealing. What is that? Okay, do you see the difference between dealers and market?
Market makers are in the agency business. Dealer can be, on behalf of brokers, they are taking the orders of their client. It's not.
Both agency business. A dealer could be, just working on the, 9 orders, just buying and selling. Probably the market maker would be predominantly, in terms of providing liquidity. In terms of, providing liquidity to the markets for the better price discovery or whatever, right? We actually do trading only for the customers, for which orders we have.
Predominantly do this market order.
We cannot say that, like, particularly for a situation like in India where you supposing don't have majority of those are limited rather than market orders, then you really do not have a function for the dealer. I think the primarily market orders suppliers, there would not be too many dealers. At least most of the people over here are dealers rather than market makers. Right?
It says that when they get order from line, generally what do they execute it because they have a.
No, dealers cannot execute. Dealers don't have it has a broker who has this market access because stock change. Because the execution system.
The problem is that in our market, the terminal ownership or dealer is the one on the sales side. On the broker side first, who is the trade given by the institution?
So it is the broker. So it is only the broker who would have access to the execution system. Right? The dealers do not have access to the execution system because dealers are not of the stock exchange membership. Situation where there is no difference between the dealer and the broker. Dealer and the broker, so the same house, the same unit, they act as a dealer. So things like some bigger houses, like so something like has as well as it is a market maker for some of the stocks. That's right. But there has to be a complete separation between the two because each dealer broker name is organization, that means what will I each dealer. So I you basically give to the broker irrespective of whether he is giving you the best price or not. Right? So there has to be a complete separation between in case dealer broker system. So each brokers who are on the floor access to the market system, they are in contact with the sending the orders to them. So, what is the scale in dealing? What is the so if you're doing it in terms of dealers, so not the brokers. When you make more, if you be a dealer, you have more clients for work. You have pension fund managers for whom you are working. Really, so your middle lane versus have a loan company. Do middle lane should have a advantage. Has many clients and many
because there you can cost many bucks among the clients.
That they would be able to make a profit. So before even going to the broker, they basically match something.
They went to source this stock. So they approach their institution say A. And
so they are going to do a lot more off-market trading and put in a packet and then send it to the brokers for execution. Right? See, then the typical structure of what is called a stock exchange is the only stock market I know that it has that. And they call it upstairs and downstairs market. So downstairs market where it goes by that option. So it is basically floor traders who basically will have to use the system and the trade comes in. One comes in, okay. But large orders never pass through the because nobody is going to send a $1 million trade, $1 million trade in the downstairs to them. Right? They have what is called the upstairs. Most of these guys are dealers and not brokers. It means they do not have again access to the execution system. But what is they have many clients where to basically find a match. So before it goes, so if I am an upstairs trader, I will do exactly what he says. I have one client calling me that okay, I want to buy 1 million shares. He basically then is all right. Now find 5 of the time. Well, do you want to sell 1 million shares? I have somebody who wants to buy. Okay. One is I'll give you 20,000, and another says I'll give you. Or I think what you can do is that whatever so what you are doing is either 3 times and one says okay. Do that. One I can use 20,000. Other says I can give 70,000. Okay. So then 80,000 with buyer and the seller. 7,000 buyer and seller. Send it to the desk. And there is 20,000 buyer and the 70,000. So what you will never know that it was a $100,000. Straight. So because in the downstairs, this is the thing which is public information. They will see this 20,000. So in a paper that I did, basically that is what we, and we are, that is all of our job. We are very sneaky and we are kind of not all these things. So kind of a detective work. So we use an algorithm by which we say any code revision. Yeah. If the trade happen within the 1 minute or within 15 seconds interval, then it's like it was a split trading. We found and a lot of those trades exactly on the basis of that. So then not for that reason, when we do it on the basis of taking the largest trade, involving all the trades, you see that there is no change in the price thing that we get, but the change in one thing, because now when you take the largest one, obviously it's going to give us a little inflated volume, but with no change in corresponding price. So activities we do that. So there could be economies of scale because of the speed effect, but not necessarily because they have hard traders, because see, at the end it has to go through the downward. So still compare with the market order, because at that point when it comes to the downstairs, it's a market order. Price is for no matter whether it is at 200,000 or 100,000, it is going to get that price, which is so giving as a buy and sell basically makes it that the buy is like a market order, pre-quoted market order, and the sell is basically because it is matching. And the first one would be a limit that you're doing, and the second one because basically it is matching is the market order. That's how it is. So that is the end of this one. So here comes the question. This what I just told you, possibly we did not, at least did not did not think that we already spent around 4 hours time. It looks like you did, or we did. So the next one is basically a little bit more heavy loaded material. So there are some models and some evidence and some of these things. Now that one is also a much longer piece than this one. So means that if we also do that day, we have another 6 hours. If this takes 4 hours, that will take 6 hours. So I obviously don't have 6 hours. I have to fly before that, but and we may not also want the next 6 hours stuff. So I think the point is that either we can stop right now, and that piece, a single piece, sometimes later. And he said that we can arrange some regular some kind of format in which we can do it electronically, remotely. Or if you want to spend the next 1 hour, half hour, or 45 minutes in piece of that one, that is me too. But remember that if you do a little piece of it, that's not going to do very much, because if you don't get the whole piece, then that listener if it is going to stick to.
According to one would be more.
That's what I do. Third part is more on that is from the Amy Hoods, which I told you he is one of the biggest names in microstructure research, and he basically came up with this model in which this premium, this particular liquidity risk premium, is also there. That is the reason why for a small stock, higher price for a small stock, in the price sense, but a return sense. So small stocks on higher return is many of the small stocks have liquidity. So you charge a liquidity premium for the risk premium that you would have. So stocks coming from, suppose everything else is the same. So these stocks from the two companies in the same industry, which are owned by similar institutional ownership. So you take up all the risk factors which are there.
So you think constant only liquidity?
Only liquidity. One stock is more liquid than the other. So this is the one which is less liquid, is a higher return. Investors will say that, okay, I will buy this stock from you, but that I will be able to sell it when I need the money is low. For extremely higher level of risk, I will be stuck with this stock than the one which has more liquidity. Return, but that's all. So, and then all those things vary between stocks, between over time. So,
Will be going back today?
yes, tonight, yeah. Yes.
Very happy today.
I'm very excited.
And being today is a morning.
No, I came on today is I came conference at IDEA. I don't know. You don't know. It's around the Institute of Research, Development Research. It's RBI funded institute, so it's completely funded by RBI. And they have these every now and then they would have a conference in they pay for the entire thing. So that's the reason why they always get good from here and there. So that it came for. So it was Friday and yesterday. Those 2 days at the conference, and today I said that so obviously I went back on Sunday, but not to the mind marriage kind of crazy. So if you want to.
We'll take it right now, and we'll talk to our peer for the webinar next session webinar, and decide where to go.
Okay, then now Microstructure is called.